pretty crazy. The market is certainly being pretty entertaining, but it's also being pretty brutal to some stocks, particularly some recovery stocks, some SPAC stocks that just haven't had their opportunity yet, and some pretty intense flips here in towards the upside and to the downside. Hang on 1 second here. There we go. All right, so let's take a look at the broader market first. And if you have not yet watched my video on what it would take for the stock market rally to stop, I highly encourage you watch that. So just look on the channel. If you're not getting all the notifications, remember, download the Meet Kevin app. Just put Meet Kevin in your app store, Apple or Android, and that way you'll get all the notifications. But yeah, look at the flippening we've sort of had on the indices today. We've got the Dow sitting basically flat. I mean, down 0.14. S&P went positive about a third. NASDAQ Technologies 0.77 and the Russell 0.11. What's fascinating about this is you've really had the 10-year Treasury, even though it's up, it's nowhere near the height that we had previously in February or March. And right now, even though it's high, it's kind of stuck, and it's leading people to plow money into the technology sector, which is pretty incredible. Now, I'm going to start with the reds because I like starting with reds. And where we're seeing the pain right now is obviously in addition to Zillow. I mean, when you stop doing one of the biggest parts of your business, it's no surprise you're going to be down 9.23%, despite being down 50% already off all-time highs. I mean, Zillow is they're probably down 65% off all-time highs now. They're just getting obliterated. But anyway, aside from Zillow, look at some of the other ones that are kind of lagging a little bit. So you've got something like Walt Disney lagging, which I thought was interesting because the parks are doing pretty dang well right now. But maybe you've got a little bit of a lag here on production. Actually, there was some news this morning on exactly that with delays on production. I want to say it's the delays on production, and that's exactly what's delaying Disney right here. So yeah, Disney delays Marvel Indiana Jones films. Okay. Several Marvel sequels and fifth Indiana Jones film. Yeah, I mean, so that's not great. Getting delays in movies is not great. InsurTech, I've noticed, has been lagging a little bit. That would be like Hippo, Lemonade. Yeah, also I think Lemonade's slightly green, but still kind of lagging, sitting at 66. The InsurTech still hasn't really met the world of, ooh, wow, tech is rallying. And that's somewhat expected because I think some of the higher valuation SPACs and InsurTech, which are also higher valuation, I think other tech is going to have to rally a good chunk before you get these to rally. So I think these are going to be some of your last to rally, but could be big to rally. Interesting to see Tesla. Wow, look at this almost bounce off of this line that we've drawn here. That's scary, folks. That's really scary, okay? I've had this line drawn here for quite a while. I have a line drawn at 880. We bounced at 875 today. That's scary. That's scary close. People doubt TA all the time, but I love it. I mean, it works. So very interesting. Piton actually trying to come back to life right now with 3% up. I think, again, this is really just folks looking for yield. Look at Macy's. Holy moly. You literally can't stop Macy's. This is insane. It is the stock of the year. I mean, honestly, if there's a stock that deserves a Stock of the Year award, it's Macy's. It is the #1 retail stock that just won't stop. I mean, you're looking at 4x year to date right now on Macy's. It is very, very impressive. And if you split up your money into like Nordstrom or some of the others, it'd be a problem. Okay, so what happened? On the 14th, we got news of Jana takes stake in Macy's, urges spinoff of e-commerce. Wow. That's interesting. Wow. That's really interesting. Yeah, retail stocks are all over the place right now. Choose carefully. No kidding. Macy's. There's some other news here as well, but not so exciting. Macy's and retailers surge on report that Saks Fifth is seeking a $6 billion valuation for e-commerce business. Oh my gosh. That's insane. So Saks might actually spin off their e-commerce business, which Macy's could, in theory, as well. But since it's still part of Macy's stock, these are turning into online plays now. That's nuts. That's really incredible. I'm gonna write this one down. Hold on a second here. Saks Ecom and Macy's Ecom. Wow. Okay. I mean, you're basically turning these somewhat disliked recovery stocks into tech plays to some degree. I have not gone to like Macy's or Saks in forever. And I'm very curious to see what the search trends are like. All right, let's go ahead and look. No, not Trulia, trends.google.com. There we go. Macy's. Macy's. I mean, I don't really see any kind of like Macy's search trend, but then again, maybe people don't really write that into Google. You do get an explosion around Christmas time, which makes sense. I mean, look at how perfect that trend is. It's pretty incredible. It's like a heartbeat. It's so perfect. But that does me very little good. Saks Fifth. Saks Fifth. Does anybody actually write Saks Fifth? Yeah, look at that. Their search trends have actually gone up over the last 5 years. I'm impressed. Ugh. 90 days. That's a nice trend up. That's good. Wow. Somehow they are getting people to shop. The demo here's got to be almost 90% women, though. Yeah. Manhattan same-day delivery. Buy online, pick up in store, digital styling, email a stylist. I mean, they're smart. This is clearly catered to women, this page, obviously. And their main page goes to women, and it's not even a redirect. You just default to women. That's interesting. So you got a men. Okay, yeah, okay, that makes sense. I just saw that. And then, of course, Macy's, probably also going to cater to women right out of the gate. Oh, you got men's suits over here, men's jackets and watches. Okay, cool. Furniture, yeah, makeup. Wow, look at this. This looks literally like Saks. Look at that. Wait a minute. Where was it? Yeah. Look at that. They're literally copying each other. Same day delivery, convenience store pickup, stores are open, your safety comes first, except that Macy's doesn't have the stylist thing that Saks does. Different business, slightly different business model. This is incredible. I have to say, I'm impressed. Very interesting. I wonder if you like, do they have buy now pay later here yet? Because what we need is a Macy, or we need an Affirm integration. Yeah. So that way Affirm can go to the moon more than it already is. Here, let's find a watch. Let's see here. Price. Discount range. Oh my gosh. Come on. I can't even get something over $250. Okay. How about just give me here we go, $350. Whatever. What's this? Can I buy now, pay later this? Klarna. But it's pay in 4. Pay in 4 is garbage. So that's not cool. No. Pay in 4 is not where it's at. Let's go to something else. Let's go to furniture. Or not furniture, luggage. I don't know why. I mean, people get obsessed with buying luggage. I get it. I used to have that problem too. Klarna, pay in 4. It's all pay in 4. When are they actually going to do like a real brand partnership here, like Affirm does? Give me something good. Affirm. Here we're gonna buy. I don't know. Let's look at this. Here we go. Bed set. $2,000. No, they don't have buy now, pay later yet. Other than the buy now, pay later of pay in 4 rather. They don't have buy now, pay later. That's interesting. See, that's still an opportunity here. And I don't know. Let's try Saks. See if they've partnered with anyone. What's something expensive over here? Here we go. I don't know, $1,000 to $2,000. Let's see what we got. And then we'll get back to the sticks. Are you gonna pay $1,000 for a DeLonghi espresso machine? As low as $88 a month. Learn more. There you go. There you go. That's competition. That's smart. Good job, Klarna. That's what I'm talking about. That's smart. That's also interesting. Saks and Macy's with the Klarna integration. Very, very cool. That's good. Good to know. So you got that competition over here competing against a firm with Amazon, Walmart, and Target. Saks Saks and Macy's are doing the Klarna. Very interesting. Klarna, are they public yet? Klarna, aren't they going public with a SPAC? Klarna rules out SPAC in favor of traditional IPO. Oh, they're going to go public. This could be interesting. Klarna says listing is increasingly plausible, but not imminent. Fintech Klarna rules out SPAC deal. That's going to be fascinating to see what the valuation is of this thing. Oh my gosh. Investors recently learned that Klarna, Sweden's buy now, pay later company, closed another round of funding valuing the unicorn at $50 billion. Holy smokes. 50 bill for Klarna? Oh my gosh. I mean, that's money in the bag for a company like Affirm then. Holy smokes. And I mean, Affirm's killing it today. The thing hit an all-time high of $159. It's sitting at $157 right now. The valuation, this has got to be like 40, 44 now. No, it's not going to be 10. That's not 10. Yeah, it's going to be 43, 44. 42.66. Whoa. I really want to see the Klarna financials. That's insane. Klarna is a Swedish bank that started in 2005, and now they're basically big for buy now, pay later. Whoa. Afterpay, but Afterpay was acquired. That's crazy. Okay. Well, I mean, that's actually really good news. I mean, if they IPO with a valuation like 60 or 70 bill and Affirm's at 42, I mean, we'll have to see what the revenue numbers are like, but Affirm got Amazon. Affirm got Target. Affirm got Walmart. Those are big. Now, again, you got the competition here at Saks and Macy's apparently not going on the big items yet here. But I mean, I guess if I go to coffee makers, let's see if they did the integrations over here as well. Nespresso. Let me see if I can buy now, pay later this thing. No, just pay in 4. So it's just certain brands again. I hate the pay in 4 thing. I say that a lot though. Anyway, pay in 4 is no different than just using a credit card. I don't understand. Anyway, but this is very interesting to see a company like Macy's run like this because of this this potential idea of a Saks e-commerce spinoff. That's fascinating because if I look at Macy's stock, this has a valuation of $8.72 billion. I mean, it's got a tiny valuation for how massive this brand is. And let me see how sales are. Oops. So if I look at Rev, we have an EPS coming in at 2 this year. I mean, it's only selling for 14 times price to earnings right now. And we are expecting growth in 2022, but then potentially flat or negative growth in the years thereafter. Yeah, it's a little bit of a problem. But still, you get to $3.74 EPS 2022, and this thing's trading for $28 right now. That's trading for 7.4 times next year's earnings. It's low. Ugh. You want to go from Redfin to Virgin Galactic? I mean, I don't know that anybody can go from Redfin to Virgin Galactic. They're pretty different. You are trading one pooper for another. Both sucking. Yeah, I don't know. I personally, I don't know. I've never been able to get bullish on Virgin. I'm not like anti-Virgin. I wouldn't short Virgin, but I haven't been able to get around valuing something I have no idea how to value. So it makes me a little nervous. Little nervous. I don't like being nervous. All right, what else we got going on in the market? In the market. Yeah, that's that's an apples to oranges. What's an apples to oranges? I'm not sure what you're saying that is. I think if you're talking about space and Redfin, that's how I felt too. Kevin officially not anti-Virgin. Oh my god. The problem with live streams. All right. So anyway, where were we? Okay. Oh gosh, Toast is getting toasted again a little bit. It's interesting. Toast has just been very volatile. Let's see here. Toast. I still think they're too expensive. But let me go to the day chart here. No, you're still doing. I mean, let's go to the hour. It's gonna be yeah. Okay. I mean, whatever. This is just post IPO volatility. Not a big deal. I don't know that there's any news here. Price target for Toast rated at $64. Morgan Stanley at 63. Yeah, they got 2 price targets today. JP Morgan at 57. They got 3 price targets. Needham at 70. Oh, they got a bunch of price targets. Goldman Sachs 52. Piper Sandler 63. KeyBank 65. Wow, they're all in the same place. There are a lot of ratings that came out today for this one. All right. And then Fuel Cell. I wonder what Fuel Cell's running at. Right? We saw this picking up this morning. So Fuel Cell, we'll take a quick peek here. We do have 3 minutes to the closing bell. What's going on with Fuel? Let's see here. Fuel Cell. It could just honestly be momentum off this energy crisis because I'm not seeing a particular reason for it. Oh, well. SL being pumped by a big on Twitter. Oh, okay. Well, there you go. I mean, that market cap is pretty small. Let me see here. So oh yeah, it's a 3.2 bill market cap. Okay, well, that'll do it. Yeah, because I don't see any news. Just be careful. Stuff like this can dump fast. And I'm like, in the grand scheme of things, it's like it is a volume move here. Yeah. All right, whatever. Wow, SoFi is almost 21. That's amazing. Well, let's listen to this for a moment. This looks like it could be interesting.
It gets yours. We grind higher again by another 4 through 40 basis points. Are we pricing in too much too soon, Kathy?
Well, I think probably so. I could see 1 rate hike in the second half of 2022. I think 2 is being a bit aggressive. But I think the Fed needs to kind of retell the story here. So the market's taking the inflation rate that we're currently experiencing, extrapolating it into the future at a pretty rapid rate. And although we don't look for a return to that 1.5% to 2% area anytime soon, the second half of 2022 is likely to see slower growth, both domestically and globally, and some easing of inflation pressure. So I think the Fed needs to kind of reset the narrative here and tell us.
I don't know. Do we think the market's pricing in rates too fast? I don't know if I 100% agree with that, but okay. Oh, we'll see. So, all right. Let's see how we're getting ready as we go into the close here. So going into the close, we have Macy's, Fannie Mae, Fuel Cell. These guys kicking butt. Playboy 8.46. Cloudflare crushing it today. Ryan here says he started investing back in April. Best day in the markets yet. Very, very nice. Good job. That's amazing. Yeah, how big is Prague? Let me look at this. PRG stock. Progenity, 40%. Oh my gosh. Yeah, look at it's a $422 million market cap. Oh my gosh. Yeah, you gotta be careful with these. Some of these, they swing fast. Hey, but if you can make money on the trade, do it. But just be careful. Yeah, the net rally is really, really nice. Good job on net. Apple goes from negative to up $1.60. No way. Let me see. Yeah, it's been a crazy day. Yeah, look at that. $1.20 or 1.22%. All right, let's listen to the bell. And then we got earnings.
The Nasdaq higher by 0.8%. Lots of big cap tech names working. Apple after its product event. Facebook, Microsoft, all higher. Small caps also up about 0.1%, though lagging the broader market.
Yeah, look at that. Russell 2000 just up about 0.12%. So the small caps lagging a little bit. Nasdaq Technology is really what's killing it. 0.84% to the upside. S&P 500 0.34% to the upside, and Dow 0.1 to the downside. Really, really incredible. I mean, wow, what a reversal of the day, because futures were red. You have, the indices were all red this morning when we first opened. Yeah, today's a big, 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 big green day. I mean, a firm being up like this, Tesla being up the way it is. I'm really impressed with Macy's. This e-commerce talk is actually really interesting. I'm going to be careful of pumps like the fuel cell in Prague. But today's the day you've got some really nice moves. I mean, look at this. Even NEO up 5%. Amazing. Coinbase is knocking on the door of 300 again. Enphase up 4%. DocuSign up 3.54. Tesla ended at 870 today. Holy moly. It's pretty incredible. You've got Trade Desk at 80.82. Wow. Lemonade's even up 2.28%. So it's starting. The Lemonade movement. Apple 1.18. Yep. Even Wayfair turned positive. Amazon turned positive. This, I still think it's the beginning of the rally, the end of the year rally, and we've been in it for a couple weeks now. Yeah, it's just continuing. So wow, really, really good. Let's go ahead and see what we have for earnings coming up. Monday's not the biggest earning day, neither is Friday, but it is another one of those days where, as usual, I could remind you to get up to $70 in totally free stock by going to metkevin.com/public. They don't buy or sell your information. They don't use payment for order flow, and you can follow me there on the social platform at Meet Kevin, so that when I trade on Public, you can see what I'm doing at Meet Kevin on Public. Go to metkevin.com/public to check it out. So, and then of course you got those amazing programs on Building Your Wealth link down below, with the price going up on the 29th because, well, inflation. Okay, so in terms of after hours earnings here, we really have PacWest Bancorp and Steel Dynamics that we could look at just to see what's going on. I'm going to look at these because I want to get any kind of indicator I can. If anybody else has any earnings they want me to look at, let me know. But any kind of indicator we can on earnings, I think is going to be good, a good tell, because we do have tech earnings coming up starting Tuesday and Wednesday. I'd love to get any potential indicator, so that way I can know, or at least have a little bit of an advantage potentially on trading earnings. And not that I trade earnings, but prices are up, so I might want to cover call or sell or something. We'll see. So let's see here. Okay. Okay, let's see. Individual company news. So we're going to pull up Steel Dynamics. We'll see what's up here. Steel Dynamics. And let's get earnings estimates too. Earnings. Okay. Okay. So implied movement here is a 3.1% move on Steel Dynamics. We are expecting, well, the stock usually moves an average of about 2.28% after earnings, but they don't actually report, it looks like, potentially until 4:30, which is kind of lame if that's true. A lot of these aren't reporting until 4:30. Well, gosh, what am I supposed to cover in terms of earnings then? Well, it's going to be a little boring. I don't want to wait around until 4:30 for earnings. Yeah, we might not actually have earnings today. Just more market insanity. We'll look. If anybody has some tickers that they want to look at, we could do that. Otherwise, we can also just kind of explore what's going on in the news in terms of any kind of reports. Nancy must have bought fuel cell. Everybody's watching Nancy Pelosi. So, okay, what do we got? Let's look at some news here. Okay, after hours, nothing major really happening here. So let's look at some headlines here. What do we got? Oh yeah, I got 2 more episodes to get through on Squid Games, and I'm not gonna buy toast. A little too expensive for me. A little too much. Icahn warns of long-term crisis. What's this?
Is low versus historical averages, but certainly moving higher, and with the anticipation and expectation that rates are going to increase. So I think that can put pressure on certain parts of the equity market for certainly. I think when you think about inflation, though, for me, this earnings season, what I'm really going to be looking at is top line sales growth, because the ability of the consumer who has a lot of money and is certainly flush. We saw credit card data this quarter come in very strong. The consumer is spending. Retail sales have continued to be strong, and the consumer is spending earlier going into the holiday shopping period. But anyway, I want to see what top line sales growth does this earnings season, because expectations haven't moved significantly lower for the top line going into the reporting period. And if companies are able to pass those increased costs on to the consumer, that's going to bode well for the stock market and the economy in general.
We had to buy Halloween costumes 2 weeks early because there are already shortages of all the popular ones. So Lindsay, as you're the earnings
boys or
guru.
you and Matt?
For the boys.
Oh, okay.
Lightning McQueen is going fast. It's a hot item. Lindsay, so as you look at the setup for earnings, which sector do you think is poised for the most upside in terms of how it's been performing into the lead up versus expectations?
Well, so if I look at the industrial and the materials sector, those sectors have they rode the last several months decently. They didn't see the massive, there was a sell-off, but they held pretty strong through that sell-off, and estimates haven't moved up significantly higher. I think there is the concern about what the supply chain constraints and bottlenecks are going to do to these sectors, but I also think higher commodity prices benefit these sectors. So these are two sectors that I'm definitely keeping my eye on throughout earnings season. This week we're going to hear a lot from a couple industrial companies. So that is one area that I'm going to watch for certain. And of course the consumer discretionary sector, because it is the one sector that we're expecting to see earnings per share decline on a year-over-year basis. So we're hoping to see that come in stronger than expected.
My bank earnings pretty strong. I mean, certainly the likes of Goldman Sachs, Morgan Stanley, and Bank of America. Has that now raised expectations for all sectors, or are people kind of still looking on what came down?
This is interesting, this conversation. At the same time as they're talking about, essentially industrials here, there's an article out that Morgan Stanley is cutting U.S. Steel, like Steel Dynamics, to a sell. Because they see steel pricing as peaking. It does make you wonder if possibly we're going to see a peaking in commodities. And maybe commodity prices will actually slowly come down again. So far, we haven't really been seeing that. Let's see here. Let's look a little bit. Let's explore that. Yeah, okay. Well, the latest Manheim used car index. I mean, this only comes out once a month, so that doesn't sound good. Let's look at something else. Let's go to like copper prices. Let's see. Okay. Copper and lumber. That's what I want to see. Oh, I hate how this website does this, the NASDAQ. That's fine. Hold on. We will figure it out. I'll just zoom in on it. There you go. So you can see copper here on the 6 month, roughly at a 6 month high. Saw this around May as well. Which is crazy because we had so much pain in the market around May. Now the market's doing pretty strongly, despite gold going up this high. I'm sorry, copper. We do also a comparison. So copper's doing well. We do a big comparison between copper and gold. And when copper's running, it's usually a strong sign for industrials. And when gold is running, it's a strong sign of uncertainty. But gold's not running. So you have a strong industrial growth, potentially weak economy being priced into things like copper and gold, hence that ratio widening. So, which I agree with. I think the market is just really wanting to boom. But let's look at lumber too. Let's see here. NASDAQ, LBS. Let's see if we get this. Lumber. I got this notification, Weeble. What does it say? It is an early release earnings for EXPI World Holdings. Really? I'll look at what EXPI is. Look at that in just a second. Let's look at lumber here too. Wow. Just look at lumber. It started running again like crazy. It's at 759 again. I mean, this was so weird. We saw this with inflationary numbers as well. Inflation figures felt like they were going to start coming down in August, right around the Delta time. We saw used car prices come down. Things were coming down. Copper prices were coming down. Things were coming down. Now they're just going right back up again. Dang. That's crazy. Somebody says, I've got a truckload of copper I need to haul into scrap and buy more stocks. There you go. I think that there are some serious issues with copper supply as well. Output from South America is down quite a bit this year from COVID and strikes. Yeah. No, I guess it's not weird. We did know that there was going to be inflation. This is true, but it inflected down, but now it's inflecting up again, right? And so this is what we want to pay attention to. Lumber up, copper up, used cars up, coming right back. I think that's also helped us contribute to this rotation back up in crypto, is that this fear that this inflation is lasting longer. And that's why we got Bitcoin at 61.2, Ethereum 37.6. Sorry, Bitcoin at 61.4 now. Cardano at 213. Cardano's been lagging in the last month, though. It's pretty much just been stuck. Apple drops Intel. Ooh, and biggest MacBook Pro overhaul in years. Wonder how Intel did on that one. Intel actually looks like it closed green today, and even green a little bit here in the after hours. The 73 damage shirt. Yeah, thank you. Yeah, critical hit. Why can't ChargePoint break $20? Yeah, that's a very good question. I do not know the answer to that. It's being a little weenie baby. It tries. Oh, it broke it in the after hours. There you go. All right, let me see what was up with that EXPI notification. So I actually don't see that. I wonder if that's just an estimate. No, I don't see any announcements on EXP. Expecting earnings per share adjusted of 0.12. And what did you say you saw from Webull? EPS Q3 negative 0.03. Yeah, I don't know. That's not what I'm getting. I'm getting a positive. So we'll see. Huh. Oh well. Anyway, what else we got going on? I mean, the aftermarket is being pretty boring. We don't really have earnings other than Steel Dynamics and a couple other ones coming out today. Pretty slow Monday. Let me see. It's amazing how we U-turn though. I'm gonna go. Let me just look at Steel Dynamics, and we'll look at some other headlines together. But yeah, no, still nothing in terms of earnings from Steel Dynamics. Okay, fine then. Let's just look at some news. NATO to expand, focus on countering rising China. Okay. Supply chain problems. Latest issues. All right, let's take a look at this. Latest news and updates on the supply chain problems causing the biggest drop in U.S. factory output in 7 months. It's not so great. All right, let's listen in here. So we have, this is Apple shrugs off chip shortages with plan to release new laptops in time for the holiday season. That's actually impressive. Apple cemented its move away from Intel on Monday, revealing 2 high-end laptops powered by its own Apple Silicon. Apple has been designing processors for the iPad and iPhone for the past decade. Nice. Good for them. Okay. Where was this talk about? Political. Okay, I want to find it. I want to see the supply chain talk. I also want to hear this talk here on inflation. Hold on. This one right here. Give me one sec.
Next year, where it's going to be very reluctant to. I think that's when we see that steepening, and the pressure has to build at the 10-year and 30-year part of the curve, because people realize the Fed doesn't care about inflation. They're not going to protect real yields. So 10s and 30s are going to take care of themselves.
Well, right now, 530s has really rolled over north of 100 basis points on September 22nd. Right now, 87 basis points. Tony, I just wanted to check in on the banks quickly to see how they were doing. I talked about Goldman earlier this morning, up by more than 50%.
All right. Nothing so exciting here. All right. Where is the supply chain stuff? Home builder confidence rises. Wall Street drifts lower as investors worry about China. Well, that was this morning. Here we go. Here it is. Supply chain problems caused biggest drop in U.S. manufacturing in 7 months. The U.S. industrial production fell last month as supply chain problems drove the biggest drop in manufacturing in 7 months. A gauge of industrial production fell 1.3% in September from the previous month, the Federal Reserve said on Monday. That missed expectations for a 0.2% rise. Manufacturing output fell by 0.7%, the biggest drop since February, and followed a 0.4% revision in August. A drop in the manufacturing of motor vehicles and parts weighed on factory output as shortages of semiconductors continue to humble operations. U.S. businesses have faced a series of pandemic-related supply chain problems. Monday's report also showed that output from utilities fell 3.6%. And then you've got the lingering effects of Hurricane Ida. Got it. Volvo Cars to list shares next week, targeting $23 billion valuation. Volvo Cars will list its shares. The Swedish car maker is expecting to raise up to $3.9 billion, with shares due to start trading October 28th. Volvo, so that was about next Wednesday. Free float of about 17 to 21%, but the offering will continue to be controlled by a Chinese car maker, whoever currently owns 98% of the shares. Wow. It's going to retain 97% of the voting rights even after the offering. Wow. Did not know they were going public with that much Chinese ownership. All right. What else do we have? ChargePoint 2025 and after is good. Finally. Get that thing over 20. Did I go to college? Yeah, I did. I went to UCLA. I know the big SEC report comes out shortly. I know. I'm going to go through it, but I don't think I want to I don't think it's worth live streaming. It's going to be kind of I think it's going to be very granular to go through. Just wait for my summary video on it. I mean, like, I don't know. Like, I want to go through it. So I'll go through it and then post a video. Give me like an hour and I'll knock it out. So, all right. Yeah, I cut earnings out of the title because earnings are boring. There's nothing. Tomorrow. Yeah, exactly. Tech earnings will be dominated by shortage talk. No doubt. Watch my video if you have not yet this morning. Actually, not this. Well, yeah, it was this morning. Watch my video on TDOC. Oh, Wells Fargo initiates coverage on TDOC at 156. But anyway, yeah, watch my video on what I think the biggest risk in the market is right now. Home prices are cooling off, sort of. What buyers need to know. What Wall Street says about Zillow's iBuy pause. I don't think much. I mean, well, then again, Wall Street sold it off. Bitcoin futures ETF. Yeah, okay. Let's take a look at these. Is Tesla delivering new Model X's sooner than expected? Is that true? Let me see here. If I order this thing now, what do I get? Model X Plaid. This is estimated delivers September. September of what? It's October. Plaid. July? What? Is this right? Are you serious? This is freaking late as anything. Are you serious? This long? Get out of town. Holy crap. I don't know how to feel about that. Oh my gosh. Hold on. Let me look at the other ones. Tesla. What do we got over here? June? Holy crap. December. Okay, this one's better. All right, so you got December over here. So that's not that bad. And then can you configure a Cybertruck? I heard they got rid of all that. Model Y. Let's see here how long for Model Y right now. Thanks for the 99 cents. April for a Y or December for the performance? Wow. They're really making people wait now. Man, when I bought my Model X, I didn't have to wait long at all. I had to wait like 2 weeks. That's not true. I think I had to wait like 6 weeks. But I mean, now you're measuring in months for many of these. Oh, well, this is not bad here. Like November for the Performance Model 3. Standard range Model 3, May. Oh, dirty. Dirty, dirty, dirty. Too much demand for vehicles. Yeah, everybody wants a new car. It's the thing. It's not just the fact that you got the chip shortage. It's that on top of that, everybody wants a new car. It's crazy. Yeah, no thanks. All right, where were we? Let's look at a couple things over here. What Wall Street says, okay, so won't sign contract. Zillow, I'm surprised this is as big of news as it is. So let's see here. CEO pointed to broader labor and supply constraints. We've not been exempt from the market and capacity issues. Backlog for renovations and closings. iBuyer activity is still a small part of the broader housing market. Company said 1,800. Okay, blah, 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 blah. Yeah, I mean, this, okay. They just overbought. I get it. I still think they should just change the price that they're offering. What is this? Steven says, the wide long range I ordered a few months back originally said January. Others who ordered after said March and April. Now says November, December for my Y. Okay, well, that's good. So you're okay. So existing orders moving up is what you're saying. Okay. I ordered a Model 3 Performance 2 weeks ago. ETA is November 1. Non-performance models wait till Q2 2022. Oh, interesting. I don't know about this. If I agree with this, Will. Well, maybe. You might be right. Actually, Will. You might be right. Because think about it. Like, even if I didn't have the labor, if I thought the market was still going to go up, I just keep buying. Because I could sit on the property vacant. You know? You could just sit on it vacant, put your hands under your butt, and make money doing nothing. But, you know, that does screw up it screws a lot of things up at a company, you know, because they don't want to get, I don't think Zillow wants to get into the business of speculating on the market, although that is possible. I think it's probably, I think if they didn't have labor shortages right now, they'd still be buying and selling. That's my guess. And quite frankly, like if you just wanted to, if you were concerned about the market falling, and again, just offer a lower price. Like Ryan's mentioned. Exactly. I've been sitting on some vacant property too. I get it. Stay away from cities. They suck. Sure, they're plenty leverage to reach. Yeah, it's probably just maxed out. I mean, I believe it. If you can't keep up with like, let's say Zillow can't even hire enough employees to manage it all. You know, you're at capacity. But again, why say we're not going to buy anything? Like you're saying, if a really good deal comes by, you're not going to buy it. Like that's dumb. Don't close the doors to everything. Just give not as desirable numbers. Be convinced to buy. You know? Short interest on Prague. Oh, yeah. Here's the day trader stock. All right, let's look at it. It's fine. There's no offense to day traders. I'm just saying be careful with these things, okay? Prague and fuel cell right now. All right, I will look. I do think the short interest phase is over, though. Or at least it doesn't last as long anymore. But then again, Prague's done well the last few days. So if you're making money on it, keep riding it. But just get ready. You got to be watching that all day long. It's actually gone up. Yeah, it's at 26.57% per S3. And that's like straight up this month from like 11%. Shorts have been going up a lot on Prague. It's true. Your first wedge deal was a gut remodel on a 100-year-old house. I feel for you. Yeah, in relation to free float. Yeah, well, that's what I said, 26.57. Still heavy in AZ. And seeing more properties with price cuts sitting over 30 days. Interesting. Yeah, I mean, this is a time of year the market does tend to slow down a little bit as well. But it's also, in my opinion, time to buy. What's with the I don't know, Clubfoot Billy, but I respect Matt and his channel. Yeah, I think it's more of a protest to politics, but I don't really know if I have an answer. That's probably the best answer I have. It's just kind of like for example, if I were running for office right now, I obviously wouldn't have my hair green, right? But now that I'm not, it's kind of like, F it. I don't know. That's the best I got. All right. Cool. I'm gonna get ready for that GME report. Yeah, I'm gonna just quickly see if there's anything else. Bitcoin ETF. We know this is coming. ProShares appears to have one regulatory approval late Friday. Company filed a post-effective registered statement with the SEC, and the NYSE approved the listing. The fund is expected to start trading on Tuesday. The ETF's pending launch helped spark a rally on the coin, up 7% on Friday, trading above 61.6. Fund sponsors have been trying for years to win approval. SEC hasn't approved anything. But again, remember, the SEC sees futures as commodities. So I think people are just getting very bullish that, oh, this is it. We're going to be at a regular ETF rather than just a futures ETF. I don't know if we're going to actually see a big catalyst on that. I'm going to put some thought into that. Now, I'll put some thought into that. Maybe I'll drop a video on that. We'll see. It's definitely good. How come we don't cover Weber much here? I love to barbecue. A live stream the GME report, really? I mean, it doesn't really make a difference to me. Would you trade in a 2016 Model S for a new Y? Why would I do that? Hold on. Replying at 4650 in live stream. Would I trade in a 2016 Model S for a Y? Probably not, because I hate buying new cars. I've been very tempted to sell my car and trade it in for a new Tesla, which is a 2017. So I kind of feel very much in the same boat. But I hate new cars because the depreciation is pretty rampant to start with. It's, I don't know if it's worth the trade. Personally, I just rather buy the stock. But then again, you could have a break even. Like, for example, if I took my Model X right now and sold it for 50 grand, let's say, and then I got a Model Y for 50, that'd be an even trade, right? Would I do that? Probably not, because I think that new car is going to depreciate way faster, which would be typical, than my old car. I feel like my old car would be a little bit more at the bottom of the curve. I might have to, my tax implications could be pretty interesting since I've written off like all of this car. So I wonder what the recapture would look like. So there'd be potential tax implications, depreciation implications. I have to deal with the headache of transferring all that stuff for a car. Like, I'm not even using the thing much. But then again, that's me. I don't know. Would I buy a used Tesla? Yeah, I'd buy a used Tesla. Your Tesla probably appreciated if you sell it yourself. Don't do a trade-in. Yes, buy Tesla, not Teslas. Yeah, thanks, Will. That is buy Tesla stock. Is Cardano ever going to start pumping? Wow, if you just bought a month ago on Cardano, that's not so exciting. You've been basically flat. But I mean, one day. All right, let me write this down. Hold on. I'll just change the title here. And go. All right. So let's see if I can get the SEC here. I really don't want to do this live, but I think I might. Let's see. SEC press releases. Or is it called a meme report? All right, should be out right now. Let's see. No, it's still not out in terms of press releases. It's supposed to be out right now, but it's not. But then again, it's within the minute, so we'll wait for it here. If anybody sees it, please let me know in the comments because we'll get it here. But so far, I don't see it. And I think Bloomberg would have it as well. Do they have it? Did they get it before me? Probably. Let's see.
The meme stock craze that peaked in January of this year, particularly the trading activity around GameStop. Now, what caused all that volatility? The report examined institutional accounts that had very significant short interest in GameStop. And it concluded that while short covering was a factor, it was a small fraction of the overall buying volume. The staff instead concluded it was positive sentiment, not short covering, that sustained the weeks-long price appreciation in GameStop. The commission staff did consider but rejected other explanations for the price rise, including naked short selling and a so-called gamma squeeze. Now, what, if anything, should be done? The report is long on facts, but it's short on recommendations. For example, the report noted that some brokers, particularly Robinhood, experienced margin calls from its clearinghouse when GameStop's price spiked up. The author suggests shortening the settlement cycle, currently 2 days, to 1 day or less. The report also urged the commissioners to consider whether game-like features in trading apps might lead investors to trade more than they would otherwise. On the issue of payment for order flow, the report noted that the wholesalers who executed those orders did so internally, and so their trades were less visible to the wider market. On the issue of short sales, the report said that improved reporting of short sales would allow regulators to better track what happens when short sales do occur. Still, investors expecting some kind of imminent action from the SEC are likely to be disappointed by this report. This is a staff report. It outlines the facts, but it contains only very general recommendations on what the SEC commissioners might do. And guys, it doesn't contain any particular recommendations on what rules the SEC might want to enact in the future. Now, Chairman Gensler has spoken about payment for order flow and gamification of trading as talking points for months now. I think the issue with this report is while it mentions this, it doesn't draw a clear conclusion and doesn't clearly show that there's harm from what happened in GameStop and, for example, payment for order flow or gamification of trading. We'll have Gary Gensler, by the way, the chair of the SEC, on with us tomorrow, 9:35 a.m. Eastern time on Squawk on the Street. Guys, back to you.
Okay. First of all, they for sure got access to that report way before we did. And they were probably just embargoed on that. But that's actually good news for payment for order flow. Let's see if we can look at the report together a little bit. So here's the report. So let's see. Let's just go through it. All right, here we go. All right, may as well. I got this. GameStop and multiple other stocks experienced a dramatic increase in their share price in January as bullish sentiments of individual investors filled social media. New highs following the attention known as meme stocks. Several retail brokers temporarily prohibited certain activity. The report of staff primarily examines the Jan 21 trading activity in GME, the most famous meme stock. Oh, look at that. The honor. The most famous meme stock, the most famous of meme stocks, against a backdrop of others. Because media attention surrounding the meme stock episode raised several questions about market structure, this report will begin with an overview. Okay, as more individuals participate in the market, as many did during 2021, it is important to understand how their orders are executed and incentives of broker-dealers when executing these orders. In particular, the ability of a small number of off-market exchange makers to trade profitably with retail order flow has led these market makers to negotiate agreements with retail broker-dealers to secure rights to this order flow. This makes sense. In turn, this payment for order flow creates incentives with regard to the end customer whose order flow is being sold. You are the product. Some individual investors might trade more frequently as commissions have fallen or been eliminated, which raises questions about the effect of novel features of their broker-dealers, like digital engagement practices. The execution of retail orders by off-exchange market makers raises further questions about whether individual investors may be subject to other less conspicuous costs and conflicts of interest. While these features are not necessarily the cause of the meme stock rally, investors should be mindful of how their orders are handled, including the difference between free and no commissions. Ooh, the difference between free and no commissions. Dynamics related to short selling are also an integral part of the GameStop story. Stocks seen by parts of the market as overvalued tend to exhibit significant short interest. And prior to January 2021, GameStop was no different. However, some in the media directly link trading activity to the presence of short interest. Yep. That's pretty much true. Characterizing trading in GameStop as an act of rebellion intended to humble the short-selling professional investors who had allegedly targeted the stock. Lastly, the episode highlighted the risks that exist while trades are settled and raised specific concerns about the mechanics of market participants. Specifically, volatility combined with settlement risk led some firms to temporarily restrict trading. We discuss aspects of equity and options in the market below. Okay. All right. Now they're going to go into a lot of background, I feel like, here. All right. It's necessary to understand the market, broker-dealer. Okay. Wow. They're going to go into a lot of detail here. I guess we can briefly look at this. So look at this here. Customer puts the order in. So let's try to understand this together. So I put, let's say, a $5 order in to, I don't know, let's just say buy GME, right? That's going to go to the broker-dealer, like Robinhood. Then it's going to go through clearing, which is going to be probably like a Robinhood clearing in the case of Robinhood. And then it goes to off-exchange brokers, wholesalers, ATSs, and then it clears and settles on the other side because you got clearing on both sides. Okay. Necessary to understand the market structure. From the perspective of individual investors, the life cycle of a stock trade starts with an investor placing an order through an account which they establish with a broker-dealer. Broker-dealer then routes the order for execution to a trading center, such as a national securities exchange or alternate trading system, or off-exchange market maker. Once the trading center executes the order, the customer receives a confirmation the trade is reported. Got it. This process will publicize trade details. The trade details are also sent to the clearing broker who affirms the trade by verifying details. The clearing broker must settle within 2 days, and this is known as T+2, by officially moving the stock from the seller's brokerage account to the buyer's. Got it. And then you clear the money. All right, we understand that. The options market is broadly similar with some differences. Standardized list options. All right, what else we are? Traded only on national security exchanges, vast number of these. And these options settle T+1. Oh, that's interesting. So options actually settle earlier. With respect to the number of series of options for each underlying security, there are more than 10,000 listed national market system. Because of the large numbers of series, there are less likely to be investor limit orders resting on exchange orders. Okay, so prices are commonly set by registered market makers, quotes. Interesting. Okay, so rather than potentially having options being priced by the market themselves, options can be priced by market makers. So in other words, MM can set the options price. Fascinating. Oops. There we go. Commission's mission is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. They oversee self-regulatory organizations such as national security exchanges, clearing agencies, FINRA, so on and so forth. Got it. Broker-dealers generally must register with the exchange. Gotcha. All right, let's get a little bit more into this. Individual investors and retail broker-dealers. Okay, so this is more background in terms of how this works. We're going to go a little past some of this background here. Payment for order flow. Some broker-dealers report that young investors and smaller accounts have been notable sources of new account openings. For example, Charles Schwab indicated that individual investor customers age 40 and below with accounts below $100,000 are driving a greater percentage of trading volume than in prior periods. Robinhood reported its average customer is 31 years old and has a median account balance of $240. That's the median. Wow. Apex Clearing, a broker-dealer that provides services to other broker-dealers, has indicated that approximately 6 million accounts that has opened in 2020 represents a 137% increase from before, with about 1 million of these accounts, or about 1 in 6, belonging to investors with an average age of 19. Oh my gosh. Wow. Interesting. 19. 1 in 6 or 19. That's cray-cray. Order execution and segmentation of individual investor flow. For stocks, trades execute on exchange. Okay, let's see. Or exchanges play a central role. Price delivery or discovery. Less than 60%. Oh, interesting. What is this? Hold on a sec. This is where we start getting interesting. A myriad of market participants and trading venues facilitate the execution of equity and option orders. While customers set the terms of their order, the retail broker generally controls where to route that order, subject to the duty of best execution described above. Well, wait a minute. I want to know what best execution is, because that can be a little shady. Where is best execution? Because I have not seen that phrase until just now. Let's find it, because that's going to be important. There it is. Okay, here we go. Okay, broker dealers are subject to conduct requirements, including the duty of best execution, which generally requires a broker to execute customer orders at the most favorable terms reasonably available under circumstances, generally at best reasonable available price. Why does this sound like a bunch of jargon meant to confuse people? Okay. In addition, the Manning rule generally prohibits FINRA members from trading ahead of customer orders. Example given, receiving a customer's order to buy and then buying it for its own account first at a price that would satisfy the customer's order without providing the customer with that price or better. Okay. So be interesting to know a little bit more about best execution. Best execution is reference 8. So this is where they talk about best. And then 9 is here. This is just disclosures. Firms that provide payment for order flow cannot allow such payments to interfere with their best execution obligations. I still want to know what the definition of best execution is. Wish there was a link for that. Maybe I could just Google that really quick. I'm going to try to Google that really quick, because that always becomes something that's very sus. FINRA. Here's a reminder. Okay, best. Oh, wow. Okay. So best execution of a customer order is key to investor protection. Okay, FINRA has codified best execution. In any transaction for or with a customer or customer of another broker-dealer, a member associated with this shall use reasonable diligence to ascertain the best market for the subject security. Okay. While the SEC and FINRA have recognized that best execution is not solely to do with price. Price is undoubtedly a key concern. See, this is where all the loopholes come in. And I think that's what's really kind of interesting to me. Yeah, because brokers aren't a fiduciary. And yeah, that's... Oh, come on. Why is it not showing up? And having a tier above best is exactly what I'm trying to find, because we've talked about that before on the channel. Let's get this into good notes. There we go. Why? Why is this so lame? It doesn't let me save this as a PDF. It's clearly because they don't want us to read this. Okay, let's try it one more time. There we go. Got her. All right, so this is all about best execution. Best execution. Here we go. All right, so here, but So it's interesting to me that they say it's not only about price. Okay, here we go. Any transaction shall use reasonable diligence to ascertain the best market. That's what it is. It's best market, not best price. Best execution is just best market. Price is undoubtedly a key aspect for retail customers. Of course it is. As discussed below, compliance with this requires members to regularly evaluate the availability of reliable, superior prices and to assure that order flow is directed to markets providing the most beneficial terms. Accordingly, member firms' best execution procedures must be reasonably designed to identify best prices and obtain best execution. So, I mean, to me, it's just a big loophole right here, is that you can balance these two and really play the game. I mean, because it's so unclear what best execution actually is. Specific guidance on best execution. Payment for order flow is broadly defined by the SEC and generally encompasses a wide variety of cash or in-kind compensation structures that a broker may receive for directing its customers' orders to a particular dealer. Payment for order flow is one form of economic inducement that has potential to influence the way a member firm handles customer orders. Long-standing SEC guidance generally holds that a broker-dealer does not violate its best execution obligation solely because it receives payment for order flow. Right. However, the SEC also states that payment for order flow may raise concerns about whether you're actually giving best execution. Sure. When conducting reviews of execution quality, firms should consider price improvements available, differences in price disimprovement, the likelihood of execution limit orders, the speed of execution, the size of execution, the transaction costs, and customer needs and expectations, and whatever else. Okay, existence of arrangements. All right. I mean, this is so broad that I don't think the regulation is actually very clear here on best execution. And this gives a lot of liberties, I think, to when it's so complicated, it basically means there are a lot of liberties given to these broker dealers. Okay. So for stocks, trades execute either on exchange or off exchange. On exchange or off exchange. Got it. Exchanges play a central role in price discovery. Exchanges quotes are the reference price for trades that exchanges execute off. Less than 60% of overall equities volume is typically executed on exchanges. Man, this gets a little complicated, huh? Retail brokers commonly send their orders of their individual investors to off-exchange market makers. One example of this practice is called segmentation. For stocks, off-exchange market makers may execute individual investor orders by taking the other side of the trade, internalizing the trade, or may route it to other trading venues. For options, off-exchange market makers also often act as consolidators by purchasing individual investor option flow. They cannot execute that flow off exchange because the OCC generally only accepts for clearing. Okay, got it. They purchase, instead, they choose options exchange. This is some crazy detailed background here. So this is really defining the role of market makers here and how they can either segment or consolidate our orders. Off-exchange market makers have more flexibility compared to on-exchange participants because they're not subject to rules of exchanges on which they quote. Interesting. 612 are required to display the price in penny increments, whereas wholesalers can execute more freely in sub-pennies. Wow. This just goes deep. Okay, I'm going to put a little mark on this page. I'm going to have to circle back to some of the detail here. To understand the segmentation portion, we're going to have to come back. Okay, let's go over here. So we're going to come back, or I'll come back probably myself, to pages 12 to 16. Let's instead go here. Look at this. GameStop. What happened? The underlying causes of the meme stock phenomenon are that are unrelated to market structure and are subject to speculation that is beyond the scope of this report. Isn't this whole report about the meme stock movement? Regardless of the causes, many individual investors traded in meme stocks, which may reflect increases in investor participation in 2020 in both equities and the options market. By early 2021, increasing numbers of individuals were downloading apps for broker-dealers. Against that backdrop, more than 100 stocks experienced large price moves or increasing trading volume that significantly exceeded broader market movements. For some stocks, the amount of short interest measured in the amount of shares sold short as a portion of total shares outstanding exceeded market averages, while others had frequent mentions on social media, including Reddit. Notably, many stocks were consumer-focused companies that were familiar names to the public. GME experienced a confluence of all factors: large price movements, volume changes, short interest, frequent Reddit mentions, and significant coverage in the mainstream media. The price and volume movements in GME coincided with substantial interest expressed in certain online forums devoted to investing, including YouTube and Reddit, subreddit channel Wall Street Bets. Interesting. Some of this discussion argued that GME was undervalued based on fundamental analysis and therefore constituted an attractive investment, while other discussion focused on its ability to transition to an e-commerce company. Alternately, others contended that unusually high levels of short interest in GME presented the potential for a coordinated short squeeze. GME stock exhibited substantial volatility throughout the prior year, and in the start of 2020, GME was priced a little over $6 per share. By April 2020, it had fallen by 50% to under $3 per share. News about GameStop led to large swings in price and increased volume. For example, on August 31, Chewy co-founder Ryan Cohen disclosed an investment in GameStop. That day, the share price closed up 23.93%. By the end of 2020, GME traded for a little under $20 per share. GME's closing price went from approximately a bottom 10 percentile to approximately median over the course of the year. GameStop had already started receiving attention on Reddit in 2019, including in discussions about short squeezes. The attention grew throughout 2020. For instance, GameStop's short interest ratio of 84% was reportedly noted on Reddit in April 2020. Price increases, trading interest, and social media interest all accelerated in 2021. Media attention on, these are the charts here. Dollar volume and trade count. Right. And then you have 2021 really over here-ish. Really looks like more of like an end of 2020, but okay. So everything accelerated in 2021. Media attention increased with the January 11th announcement by Cohen of Chewy that he would join the GameStop board of directors. On that day, GameStop reached an intraday high of $20.65, approximately 17% above its prior closing price. And on January 13th, rose to $31.40 from $19.95 the prior day. Oh, that sounds like a sale. On Jan 22, the price of GME rose from 43 to 72 in 3 hours. By Jan 27th, GME closed at 347. The following day, my birthday, we had reached an intraday high of 483. As the price increased, so too did the trading volume. From Jan 13th to 29, the average of approximately 100 million shares traded per day, an increase of over 1,400%. On January 22, the day of GME's highest share volume in a month, 197 million shares traded. Overall, GME's intraday price increased 2,700% from its intraday low on Jan 8 to Jan 28. Followed by a decrease of 86% from that day to the first week of February. The daily closing price changes at the end of January were also highly volatile in dollar terms. Okay. So increasingly coincided with a sharp number of individual accounts actively trading GME, as shown in figure 4. Where's figure 4? Unique trading account increased from less than 10,000 accounts to nearly 900,000 accounts. No way. Look at that. Daily unique count of accounts trading GME by type. Holy moly. Look at that. You went as high as 900,000 over here on the 27th. I mean, that is peak momentum. That's crazy. Some institutional accounts had significant short interest in GME prior to 2021, far exceeded other meme stocks like Dillard's, Bed Bath. Look at these honorable mentions here. Bed Bath, Koss, Fizz, Naked, AMC. In addition to individual investor activity, there was significant participation from institutional investors, including several large hedge funds that purchased GME. Some of those purchasers may have been used, or at least in part, to cover short losses, short positions. That makes sense. The potential of buy to cover volume to increase share prices thus led to further buys to cover, often referred to as a short squeeze. The role of a short squeeze may have played is discussed further below. After peaking in late Jan, the volume of trading in GME shares and GME price declined substantially. GME's decline coincided with several other brokerages' decisions to restrict trading in GME on Jan 28th. By Feb 3, GME's price was below $100 per share and fell as low as $40.59 in February, significantly above its January 4th closing price. GME's price rose back above $100 at the end of February and has remained at that level since. By the end of Jan 21, some funds had closed out their short positions in meme stocks, realizing significant losses. In contrast, some funds that were long GME saw significant gains. Some investors had been invested in the target stocks prior to the market events benefited unexpectedly, while others, including quantitative and high-frequency hedge funds, joined the market rally to trade profitably. Staff believes that hedge funds broadly were not significantly affected by investments in GME and other meme stocks. Staff did not observe that any advisors to private funds and registered funds experienced liquidity issues or difficulties with counterparties. Oh, how interesting. None of the hedgies had problems buying, eh? None of the hedgies had problems, but retailers did. Oh, what a burn. What a burn. Staff believes that hedge funds were not significantly affected. Fascinating. Yet, while swings in GME share price and volume attracted significant attention, they were not unusual for Jan 2021. For instance, single-day price changes on Jan 27th in Koss 480%, 301 AMC, Naked 252, Express 214 were larger than any single day GameStop price change. Oh, that's interesting. These were larger than any single day price change on GME. In fact, since 2020 began, 134 common stocks had at least 1 day price increases greater than GME. Wow. That's kind of a slam right there on some of the brokers who restricted trading in GameStop because, sure, it happened all at the same time, but it's like, hey, 134 other stocks had this kind of price movement that GameStop didn't actually have, or greater price movements, right? The market events of Jan 21 also reflected or affected some ETFs and private funds. The volatility was significant enough to impact ETFs that held GME. For example, the retail ETF saw its position in GME increase from 1.5% of portfolio to 20% of its portfolio on Jan 27th. The same day, XRT experienced net redemptions of 506 million, representing 76% of its net assets, which is the second largest net redemption in the fund's history. This is basically people taking their money out. Wow. Over the 3-day period, XRT traded at an average bid-ask spread of 7 cents. Wow. Compared to the 52 average of 1.1 cents. At the same way, Wedbush Gamer ETF position in GME increased from 2% to 17%. Over the 3-day period, Gamer traded with a bid-ask spread of $1.32. Wow, these spreads blew up. While this volatility raised questions about whether the market price of an impacted ETF shares might decouple from the ETF's net asset value, staff observed that operations proceeded in a normal course for ETFs, despite heightened activity. For example, XRT's closing price exhibited a premium of 1.25% to net asset value, which is larger than historical but does not appear abnormal, basically, is what they're going to say. Larger than historical but does not appear abnormal. Indicative of failure. Exactly. Fine. Okay. Short selling and covered shorts. All right. So GameStop at the time, at the time was notable for its significant short interest. Figure 5 shows short interest. In the past, GME had several periods of high short interest, but none as high as the levels achieved from 2019 to mid-21. GameStop short interest hit 50% of shares outstanding for the first time in 12, and then again in 15, 16, and 18. So this has all happened before rising further in 19. From then until early 2021, GameStop short interest hovered around 100%, hitting a high of 109%. Some commenters have asked how short interest can get as high as it did. Short interest can exceed 100% as it did with GameStop when the same shares are lent multiple times by successive purchasers. If someone purchases a stock from a short seller and then subsequently lends the stock out again, it will appear as if the stock was sold short twice for the same purpose. Short interest tends to be quite low for large non-financial stocks. They are often less than 2.5%, whereas large non-financial or small large financial stocks, they tend to be less than 13%. Got it? So large non-financial stocks, 2.5%. Small, 7.5% or 13%. Got it. Few stocks, if any, have a short interest greater than 50% on any given day. Until recently, short interest of more than 90% was observed only a few times. Oh, that's super rare, in other words. 2007 and 2008. When examining short interest as a percentage of shares outstanding, GME is the only stock that staff observed as having a short interest as of more than shares outstanding in January 2020. Wow. GameStop was the only one. Given that high level of short interest, together with price movements in GameStop, a natural question is the degree to which these price movements arose from a short squeeze. Indeed, some of the meme stock trading was described in news coverage as an act of rebellion against short-selling professional investors who had targeted GameStop and other stocks. A short squeeze might occur when an event triggers short sellers en masse to purchase shares and cover their short positions. For example, if there is a sudden increase in the price of a stock being shorted, short sellers would face margin calls requiring them to post additional collateral or exit. Short sellers that cover are buying the stock, creating upward pressure. We know this, which could cause other short sellers to exit, and you basically get this up spiral. Got it? In seeking to answer this question, the staff observed that during some discrete periods, GameStop had sharp price increases concurrently with known major short sellers covering their short positions after incurring significant losses. During these times, the short sellers covering their positions likely contributed to increase in GameStop's price. Okay, so basically the short squeeze likely is what happened in part. Staff observed discrete periods of sharp price increases during which accounts held by known short sellers were covering. Got it. Okay. However, it also shows that such buying was a small percentage of overall buy volume, and that GameStop share prices continued to be high after direct effects of covering short prices would have waned. The underlying motivation of such buy volume cannot be determined. Perhaps it was motivated by the desire to maintain a short squeeze. The desire to keep the pressure on. Whether driven by a desire to short squeeze and thus profit from the resulting rise in price, or the belief in the fundamentals of GameStop, it was positive sentiment, not the buying to cover, that sustained the weeks-long appreciation. It's all sentiment. So momentum, not a short squeeze, is basically what they're saying. Wow. That's interesting. Yeah, they're basically saying, yeah, sure, there were some price increases because of shorts covering, but most of it was due to momentum. Yeah, makes sense. It's in part why I think a lot of the, trading off solely short interest is a little dangerous. But it could lead to that social momentum. Okay, another possible explanation could be a gamma squeeze. Oh, man. Sorry, I need to take a sip of coffee to keep reading this. This is exhausting. Thanks for hanging out. Hopefully you got yourself life insurance in as little as 5 minutes. I'm going to have to chug this one. There we go. Woo. I wonder if they're moving in after hours at all. GameStop. Not really. 0.14%. And AMC also. There's nothing. All right. Gamma squeeze. Man. Here we go. Another possible explanation could be a gamma squeeze, which occurs when the market makers purchase a stock to hedge the risk associated with writing call options on a stock, in turn putting further upward pressure on the underlying stock price. As noted, though, staff did not find evidence of a gamma squeeze. Wow. One of the main drivers of a gamma squeeze is an influx of call option purchases, which causes market makers to hedge their writing of call options by purchasing the underlying stock, driving up the stock price in the purchase. While staff did find that GameStop options trading volume from individual customers increased substantially from 58 million on Jan 21 to 563 million on Jan 22, peaking at 2.4 billion on Jan 27th. The increase in options trading volume was mostly driven by an increase in the buying of put rather than call options. Whoa. That's huge. You know what this does is this whole thing goes to show that this was all retail momentum. This is literally how powerful retail is when they all get together. You don't need short squeezes. You don't need gamma squeezes. You just need lots and lots of people. This is actually really cool. The unusually high amount of short selling raised questions about whether some of the short sells were naked, namely made without arranging to borrow the underlying security. Oh, wow, that's interesting. Hold on. Further, data shows that market makers were actually buying call options rather than writing them. Wow, okay. So the unusually high amount of short selling this gets too complicated. I'm not going to highlight that. The unusually high amount of short selling raised the question of, well, because I guess maybe I can explain it really quick. The reason you might buy a call option as a market maker is if a bunch of other people are selling calls, which are bearish moves, right? So they're actually hedging in the opposite direction. So it's literally the opposite of a gamma squeeze. Kind of interesting. All right. The unusually high amount of short selling raises questions about whether some were sold naked. Okay. When a naked short sell occurs, the seller fails to deliver the securities to the buyer, and the staff did observe spikes in fails to deliver in GME. However, fails to deliver can occur either with short or long sales, making them an imperfect measure of naked short selling. Interesting. Moreover, based on the staff's review of available data, GME did not experience persistent fails to deliver at individual clearing member level. Specifically, staff observed that most clearing members were able to clear any fail to deliver relatively quickly, and for the most part did not experience fails to deliver within for multiple days. Okay, so in other words, GME did not experience fail to deliver at an individual clearing level. Okay, so in other words, they're basically saying not really on the short squeeze, not really on the gamma squeeze, not really on the naked. They're just basically saying retail powerful AF. The ape's strong, y'all. That's what they're saying here. Finally, as discussed above, the volatility in GME impacted some ETFs due to their holdings in GME and potentially the short interest in the ETFs themselves. Most notably was the XRT, the ETF of retail companies. Okay. As GME increased in value, price changes in XRT became increasingly driven by XRT. Well, this is obvious. Okay, we already talked about XRT, though. This is not so exciting. Let's go ahead of that. Okay, capital issues. Okay, here's dirty stuff. Clearing agencies, the NSCC, and to a lesser extent the OCC, played important roles during the January 2021 GME market events. The risk management mechanisms of these clearing agencies effectively led others in the transaction chain, such as retail brokers, to pause and manage risk exposure that arose out of these. Both the NSCC and OCC NSCC explained, both the NSCC and OCC margin requirements returned to prior and more historically consistent levels. Right. So really, they're blaming the NSCC and the OCC on why Robinhood potentially paused trades. As mentioned above, high volatility in trading where share prices whipsaw by hundreds of dollars. In highly volatile trading, where prices whipsaw by hundreds of dollars, the NSCC may require more margin to guard against an increase risk of defaults, which may occur if, for example, buyers do not carry through on paying for a stock that has plummeted, or sellers do not carry through on delivering a stock that has skyrocketed. So you increase the margin requirements for this case. Got it? Okay. In response to market activity during the trading session, the NSCC made intraday margin calls from 36 clearing members, totaling 9.6 billion, bringing total margin required to 25.5 billion. Specifically, the NSC observed unusual volatility in certain securities, including GME, which presented heightened risk to the clearinghouses and the members. Got it. As a result, it calculated and assessed against certain affected members the remaining 4.6 billion of additional special charge. Okay. Let's see here. In addition, several NSCC members were subject to an ECP charge because of the ratio of excess risk. What the heck is that? Rules-based discretion to waive the charge for all members. Absent this waiver, one broker-dealer would have had an additional ECP charge of more than double its margin requirement of 1.4 billion. This was honestly probably Robinhood. So in other words, this is my guess. Okay, this is just a guess, but I'm going to guess this is Robinhood. And basically, the requirement on Robinhood would have been even harder had they not waived one of the requirements, one of the many requirements. I don't know if they're saying this. Well, actually, no, maybe you are right, Victor. Actually, I see what you're saying. I see what you're saying. You're basically saying the only thing that was keeping the movement alive was the retail movement. And because the brokers got in the way, the retail movement got paused. It's a good point. It's a really good point. Bro, this guy calls me all the time, man. Stop it. Hold on. Okay. Anyway. So, all right, let's keep going here. Okay, any members? ECP charge. I want to look that up really quick. ECP charge. ECP charge. Electronic check for some NSCC. ECP is a penalty. Oh. It's like y'all done bad. Now you're going to pay us a penalty. I see. Okay, so that's a penalty. And they're not naming Robinhood here, but that's what we're guessing. So that's a penalty. Interesting. It's fascinating. Okay. Yeah, this is interesting. It does raise that question a lot of I'm going to do this was where we talked about the short sellers. This is where we talked about the failed to deliver. So in other words, pauses killed only support. Yep. Okay. Okay. Well, this is interesting. Look at this. Look at this. The NSCC, like most central counterparties, does not instruct its member firms to stop trading or clearing individual symbols because its rules do not give it that ability. However, as discussed below, some broker-dealers restricted activities in a limited number of stocks in reaction to margin calls and capital charges imposed by the NSCC. This would be a decision made by the broker-dealers and not directed by the NSCC. Right. I mean, I could see where Robinhood, like, for example, is between a rock and a hard place, because basically the NSCC could just bankrupt Robinhood for like with this extreme request, and then the NSCC can go, "Yep, we didn't stop trades, Robinhood did." You know. All right, trading restrictions. In their customer agreement, some broker-dealers reserve the right to decline customer orders or cancel trades. Such actions could be taken, for example, for legal compliance or risk management reasons. GME and other stocks experience increased levels of volatility. Some brokers with a large individual investor customer base restricted some types of trading by their customers in those stocks. One narrative at a time attributed the broker-dealer trading restrictions to pressure from hedge funds. Ooh. And their commercial partners. Ooh, let's see where that goes. The narrative was the subject of testimony at the congressional hearing, where witnesses testified that trading restrictions did not result from such pressure. Instead, some of the impact, which is not what we heard from the lawsuits. The lawsuits definitely put a little bit of sus on this. But those are just lawsuits. You'd say anything. Okay. The brokers are pointing the finger at the NSCC, right? The actions of one broker-dealer helped illustrate what happened. The staff observed that on January 26th, one broker-dealer began increasing both initial and margin maintenance requirements in customer accounts holding GameStop. Margin requirements began at 80% and then increased to 80% the following day. This firm also reduced the trade limit on GME option contracts from 5,000 contracts to 3,000 per customer. The next day, the firm limited it to 300 and then to 100. On January 28th, the firm stated it would restrict all new purchases in 8 securities. Why don't they just say Robinhood and place them in a position closing only status? On January 29th, the firm stated it would lift all PCO status and implement a series of limits on accounts. The firm made adjustments throughout the day. At one point on January 29th, restricted securities grew to over 50 names. The firm stated it was no longer permitting fractional share purchases. The firm stated it would only allow net new whole share positions. Firm erased the limits over the next week and removed them entirely on Feb 5. Okay. Some broker-dealers temporarily restricted trading for stated reasons they did not. Okay, hold on a sec. Let's see. Okay. Some broker-dealers temporarily restricted trading. For example, 2021 firm stated they restricted purchases in GME and AMC for its customers and required customers to post additional margin for one day only. Other brokers restricted trading for capacity issues. For example, one system created a unique ID for each order, but purportedly reached a limit order of the unique IDs it was able to create. The following day, when the firm realized it would likely run out of unique IDs again, it restricted customers from making new purchases. Yeah, that sounds like a bunch of BS. Customers were still permitted to close. It's basically the same thing. Okay, so the staff also observed differing practices among broker-dealers when notifying customers about restricting trades. Some broker-dealers notified customers when they had imposed trading restrictions through various means, including emails, pop-up messages, or posts dedicated on customer service platforms. So they're really just making observations here. Yeah, and they're showing how different companies reacted differently. I mean, Robinhood went pretty extreme. Some folks say that, what's it called? Robinhood went way too far. GME trading in 2021 shifted to prevailing distribution of GME. Okay. Individual activity increased, then fell as volatility increased. Approximately half of GME's dollar and share volume reported as calls was executed on national exchanges. Blah, 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 blah. to avoid internalizing an increasing percentage of volume executed on exchange when volatility spikes may indicate that market participants, including wholesalers, are seeking to avoid internalizing customer orders to reduce potential losses when hedging becomes more difficult. Yeah, that makes sense. Distribution on exchange or not exchange. Well, this is non-exchange went up. Non-listing exchange. See, these are the dates over here. So off exchange. An increasing percentage of executed on exchange when volatility spikes may indicate that market participants are seeking to avoid internalizing customer orders. But that's weird. But when... Yeah, that doesn't make so much sense, this particular chart here. Because you actually see more happening off exchange. Non-listing exchange. Unless I'm reading this backwards. What's a non-listing exchange? Non-listing exchange versus a TRF and the NYSE. I mean, NYSE is obviously the exchange, but that looks bigger. I don't know what TRF is. TRF exchange. Trade FINRA. Otherwise, and then what's the other thing? A non-listing exchange. I have no idea. Whatever. I don't know that this really makes a difference to the bottom line. All right, let's keep going. Vast majority of GME stock. Oh, here we go. Stock trades executed off exchange in January 21 were internalized, 80%. Okay. The market for internalization of GME was highly concentrated, with 88% of internalized dollar volume in January executed by just 3 wholesalers. Citadel accounted for nearly 50% of the internalized dollar volume during the month, rising to a high of 55%. Virtu Americas accounted for 26%. Okay, order of magnitude larger. Citadel internalized approximately 4.2 billion of GME, 23 million. Okay, some comparisons of size. Okay, to better understand the market for GameStop equities and options during January, it is important to look beyond volatility. While volatility, price, and volume increased dramatically in the last 2 weeks of January, market participants also experienced multiple volatility-induced trading disruptions and deteriorations in some measures of liquidity. Consistent with increased volatility, various measures of liquidity declined substantially during January. Okay. The size of best price quotes of GME also decreased. So in other words, people are getting ripped off more. Okay. So lack of shares available. So people were, this is basically saying people went crazy hodling. That's what they're saying here. Huge hodls. That's interesting. Okay. Look at this. This is interesting. Limit up, limit down trading pauses were triggered on 6 trading days in late January. Lulled is a trading mechanism that attempts to address extraordinary volatility. If either the national best bid equals the stock upper bound or the NBO equals the stock's lower bound for 15 seconds, the stock's trading will be paused for 5 minutes. It's interesting how it's automated like that. 40 pauses compared with, so these are all automated pauses basically because of so the pauses are really happening due to a lack of liquidity. Oh, I understand. Okay. Pauses due to lack of liquidity. Interesting. Okay. Consistent with trading activity in GME stock, GME options increased significantly in Jan 21. Well, yeah, no kidding. $800,000 a day from the beginning of 2020 through September that year. GME options traded with a median of 16,000 contracts per day with a maximum of about 172. Basically a median dollar volume of over 800,000. and a maximum of about 42 million in one day. And in January, we went to over $8 billion of volume. That's insane. But actually a good portion of put volume here. Yeah, that's a big portion of put volume. So you definitely have people taking both sides. Yeah, look at that. That's actually more puts. That's crazy. Yeah, that kills the whole gamma squeeze argument right now. Wow. Based on all this trading, implied volatility rose dramatically. For example, measures of implied volatility, right? Yeah, I mean, it's crazy. It makes sense. 9 times higher than the average. It's kind of 9 times higher than the 22 average. Individual customer accounts made a high percentage of options trading in GME during this time. 60. A small number of retail-focused online brokerages had the majority of volume from individual customer accounts, with Robinhood and TD alone accounting for half the volume. Whoa. In mid-January, individual customer accounts reached a peak of 91% of the non-market maker volume in options. Wow. It's just the apes. That's literally what this is. By late Jan, individual customer accounts were associated with only 56% of non-market GME traders began to suddenly close all their call option positions. By late Jan, individual customer... Wait, hold on. By mid-Jan, individual customer accounts reached a peak of 91% of the non-market maker volume in options. By late January, individual customer accounts were associated with only 56%. In other words, people stopped, like, the meme movement slowed down, so you had people, like, the momentum was already slowing. So this is the slowing momentum was already happening. So the slowing was happening. The pause was really just the nail in the coffin. That's what it was. Fascinating. Extreme volatility in meme stocks in 2021 tested the capacity and resiliency of our securities. At the same time, trading in meme stocks highlighted an important feature of U.S. secure broad participation. However, blah, blah, blah. Okay. So these are just some conclusions. Trading in dark pools. Much of the retail order flow in GME was purchased by wholesalers and executed off exchange. Such trading interest is less visible to the wider market, and payments to broker-dealers may raise questions about execution quality. Further, though wholesalers increasingly handle individual investor order flow, they face fewer requirements. Okay, so this is really just an observation. Much of the retail order flow in GME was purchased by wholesalers off exchange, and that such trading may basically be lower quality. Interesting. Lower quality. Okay. And that makes that's what we saw over here. That you had more occurring off exchange. And that these could potentially be just lower quality for retail. So retail gets screwed. Okay. And we talked about the NSCC, game-like features and celebratory animations. I mean, this is just kind of nonsense for me, honestly. This is like, oh, big deal, you know, celebratory animations. Short selling market dynamics. While short selling at calls on social media for short squeezes received a great deal of media attention, the interplay between shorting and price dynamics is more complex. Okay, so they recommend potentially improved reporting. Big deal. That's whatever. I mean, that we want that. But it's not really like a conclusion. Boring. This is just a repeat. Oh, that's the end. Wow. Okay. We went through it. It's kind of interesting. I'm going to do a summary. I'm not going to do it now because it's going to take me a minute to put together. Yeah, that was fun. Jeez, I'm exhausted. That took forever. This took an hour to go through. We did it live. It's very interesting to me. I mean, you're basically saying this was retail driven. And yeah, retailers did get screwed by trading in dark pools. But this was a retail trading movement. Had nothing really to do or little to do with the short squeeze or gamma squeeze. Yeah, that shows the power of retail. Cool. Did anything else happen over this last hour? I feel like I've been out of it now for an hour. Let's see. Top news. Not really. Yeah, not really. Okay. All right. Well, folks, thanks for being here. If you found this insight helpful, consider subscribing. Get yourself up to $70 in free stock, link down below. And, of course, check out the programs before the price goes up. That would be on August. I'm sorry, August. Jeez. October 29th is when the price goes up again. All right, folks. Thanks so much for being here. January was just a sneeze. All right. We'll see you, folks. Bye.